Good morning, everybody, and welcome to today's Advisor webinar. Look, we really appreciate you taking time out of your busy day. It's end of financial year. And we recognise too, it's a really challenging time to be a financial advisor with the extent of regulatory change, legislative change and all the education requirements. So we really do want to call that out and congratulate you and applaud you for the great work that you do. Look, with resilience in mind and the spirit of resilience, I've been thinking a lot about a woman I look up to, Auntie Isabel. She's a woman from the Simpson Desert. She's in her mid-70s, she's blind, and she's been fighting for decades for equality for women, First Nations women around the country. And so I think about you and who inspires you in resilience, but I want to acknowledge, before we begin, the First Nations people here today, where Will and I are sitting. We're meeting on Turrbal and Yagara country. So I would like to pay my respects to their elders past, present and emerging. Look, we have quite a packed agenda today, and so we want you to get involved. If you want to submit a question, if you've got any technical issues, you've got the instructions there up in the screen in front of you. So get involved, get on board. We've got a very packed agenda. Now, just for those of you that don't know me, my name's Anne Fuchs and I head up advice and retirement at Sunsuper. We've got a fantastic team of professionals. Some of those help members on the phone with intra-fund advice, and some of them, and many of them you know and love, our advisor growth team, who there work with you to help you learn all about Sunsuper's fantastic product and superannuation and retirement options. Look, 1 July is a really big date. There's been a number of legislative changes off the back of the Royal Commission, and Will Burke is going to talk to us about that. But before we do, I of course need to give a general advice warning, and as you're all financial advisors, you would know this very well, that obviously this is just general information only. It's not taking into account your personal circumstances, and if you've got any questions, you can call us on 13 11 84. So Will Burke is my first guest, and we do have the extraordinary Brian Parker, our Chief Economist Extraordinaire, coming up after Will. But Will is here to talk to us today about the changes in relation to advice fees and MySuper. Quite a very big and important thing. Hello, Mr. Burke. It's good to have you here.
Thank you, Anne. It's great to be here, and thank you for the kind introduction. And thank you, everybody, for coming along today and tuning in. So I'm here today to talk through some legislative changes which are affecting advice fees and how they'll affect your engagement with Sunsuper. Just to start off with around the MySuper and monthly advice fees, as you may know, the Hayne Royal Commission recommended that advice fees be banned from MySuper products. This was subsequently legislated as a ban on ongoing advice fee from a MySuper product. At Sunsuper, our MySuper investment option is a life cycle investment strategy, which is our default investment option. It is important to note that as advice fees are deducted proportionately across a member's investment options, that if any portion of a member's balance is in the life cycle option, the monthly or ongoing fee is unable to be paid. There is no impact to upfront fees. Before I proceed further on some of the new changes to Sunsuper advice fee framework, I just want to look at a timeline of advice fees at Sunsuper. And while we've had initial advice fees for many years, it was only in September 2017 that we commenced having ongoing fees deducted from the fund. While initially this was limited to 2 years in line with opt-in requirements at the time, in 2019 and in line with the Royal Commission recommendations, we reduced the ongoing fees to 12 months. While at the time we considered the 1-year fee to be an ongoing fee, with the new legislation, our ongoing fee is now considered to be a fixed term fee. So what's changing? So as mentioned, there have been a number of recent legislative changes which affect ongoing fees. And I'm here today to announce that we'll be uplifting our service offering to both align with the legislative requirements, but also to increase flexibility in working with Sunsuper. So from 1 July, all new fee arrangements will fall under our new advice fee framework. And we've added in the flexibility of having an ongoing monthly advice fee, which is renewable, in addition to our existing fixed term advice fee arrangement. This screen summarises our new advice fee framework, and there is no change to initial fees. For monthly fixed term fees, we have improved this by adding in a defined start and end date, which means that the fixed term fee will now line up with your ongoing service agreements with your clients or fixed term agreements. And to reiterate an earlier point, all existing ongoing fees that are already been deducted from your client's SunSuper accounts are now considered to be a fixed term fee. So as mentioned, the enhancement we will now offer is a monthly ongoing fee, which is then renewable. Given this is new, a fee could not be renewed or not likely to be renewed until July 2022, and so we will release the fee renewal consent form in Advisor Online closer to that time. Consistent with the monthly fixed term fee, we will also have a defined start and anniversary date to line up with your service agreements. To expand on this a little bit more, for monthly ongoing advice fees, the start date of the fee can be 30 calendar days in arrear or in advance. Where a day in arrears is selected, SunSuper will back pay any missed fees in a lump sum payment. And if a future date is selected, SunSuper will of course hold off commencing the fee until that date. When renewing the monthly ongoing fee, we will accept the fee renewal form up to 150 days after the anniversary date. And we will back pay any missed fees as a lump sum payment. As mentioned, this framework has been moulded by the legislative requirements. Just a few things to note. The monthly advice fee start date cannot be more than 30 days prior to or post the date the member signs the advice fee form. The term of the agreement cannot exceed 365 days, and the fee form must be submitted to SunSuper through Advisor Online within 90 days of the member signing the form. You should have by now received a fact sheet to your email with full details of the changes and the particulars. So please refer to this fact sheet. Of course, your SunSuper BDM team that you can see here is here to help. So please reach out to them directly or via the details on the screen. And I'll hand back to you, Anne.
Bravo, Will. That wasn't easy. There's a lot of detail there. And look, we have been working really hard to try and solve for, I guess, the complexity around how you can continue to get paid for the great advice you give. We know at SunSuper, with the analysis we did, which we actually presented to the Minister, Jane Hume, those members who are paying an ongoing fee to their advisor are 7 times more likely to put in voluntary contributions, twice as likely to consolidate. Female members are much more likely to catch up with their male counterparts at retirement. So, we know that our members are much better prepared for retirement because of the great work you do. So it's been really a top priority for us to try and solve this with a very short time frame, and we'll continue to look at what we do to drive more efficiencies and simplicity when you're dealing with SunSuper. And look, I will, before I introduce our chief economist, I might just tell you all a secret that in the spirit of simplicity and making it easier, we're getting to the pointy end of launching Xplan data feeds as hot off the press. So I keep joking that the angels and saints will take me up into heaven when it actually happens, but it's really getting very close. And that's going to be another really, I think, important thing to make it easier for you to provide high quality advice to your clients who are also members of SunSuper. Now, the man that's about to come up really needs no introduction. He's a bit of a celebrity extraordinaire over many years in the financial advisor community. Our chief economist and rock star, Brian Parker, who is in Sydney town and hopefully keeping safe and sanitised and lots of hand washing. How are you, sir?
Safe and well so far. The office is a bit quiet today. Yep. Obviously, I think after the announcements yesterday, I think a lot of people just decided to work from home. Sydney is very, very quiet this morning.
Yeah,
it was like driving into work this morning was like coming in early January when everyone was on holidays. Very, very quiet.
Our fingers and toes are crossed, though I'm on some level hoping, being a parochial Queenslander for the state of origin, whether your players make it up to Queensland, if we can leave some of those Roosters players from the Waverley Council down south of the border, that wouldn't hurt. I'll be at the game on Sunday. But now, for those of you who maybe are not across it, we are sort of getting moving along with this merger, aren't we, Brian? The Q Super, Sun Super merger, probably the most complex merger in the history of superannuation, if not financial services.
Yes, absolutely. And given the size and complexity of the transaction, this is going to take some time. I think while we do clearly have some milestone dates coming up, the most important thing is to get this done right, rather than get this done to a timetable, if you like. So, really making sure that this is done properly and totally in the interest of our members. That's really the main game at this point.
And look, and to that point, because it is going to be done methodically, thoughtfully, in a considered fashion to keep risk well managed and in members' best interests, we just wanted to touch base with you and again, in the spirit of, I keep using that expression, but in the spirit of how we like to work with you, we like to be very transparent, available, accessible. And so we wanted to let you know that this is going to take a while to roll out, but there is some really great news in terms of our investment team with Ian Patrick as our Chief Investment Officer and Charles Woodhouse as the Deputy Chief Investment Officer, Brian.
Absolutely, and that was a very well received announcement by both investment teams. I currently report to Ian Patrick, so the fact that Ian Patrick is the CIO, that's good news from my perspective, and it's also very good news that Charles Woodhouse is remaining with the merged entity. It just means that having two world-class investment professionals guiding the merger from an investment perspective is really good news.
That's right, and when we were talking to Lonsec and Morningstar about the great news, we just reiterated to them, and they were really pleased with that news, that it shows how much we recognise as a fund our people are our greatest asset, and having that continuity and stability is so important for the success of the new merged entity. But we're, and we will, as I said, there's not much more to really say in terms of the merger right now. But if you've got any questions, that you can always contact any of us in the business development team. But really, Brian, you and I wanted to more just highlight what a stellar performance there's been in recent times. If you could give us a little update on how you're seeing the world and investment performance for Sun Super.
Yeah, I think the truly remarkable thing is just how quickly financial markets rebounded from the crisis of March last year. The remarkable thing is, even though the COVID crisis is an ongoing reality across the world, but if you looked at the performance of share markets since the end of March last year, you wouldn't know it. And really, I describe in presentations to advisors and to members, if I think about the crisis from a financial markets perspective, it was kind of like having the GFC compressed into about 2 or 3 weeks. It was a very, very intense period, but as soon as we started to see infection rates begin to come under control the first time, but also when you saw the massive policy stimulus thrown at the economy and thrown at financial markets, really that drove the turnaround. The markets increasingly saw a light at the end of the tunnel and have come to believe that light is not a train. And that's unambiguously good news. So the returns have been really quite stellar. So this financial year is shaping up to be a very, very strong one for members. So we're looking at, if I think about financial year to date, for example, the median fund financial year to date, so for the 11 months to the end of May, has done about 15.5% or so. Sun Super has done a bit better than that. So our financial year to date number is about 18% or so, a bit over. Which means that if I think about Sun Super's performance relative to competitors, we're ahead of the median fund in both the Super Ratings and Chart West surveys over all time periods. And we sit pretty much in the top quartile over most time periods in those surveys. So very, very pleasing recovery in the absolute performance for members, which is really most important, but also a very good recovery in Sunsuper's performance against competitors. So it's been a very, very strong year from an investment perspective.
I mean, that is good to hear. Ultimately, our core business is to grow the wealth of our members so that they have a dignified and secure retirement. I think, Brian, if I reflect 12 months ago, we were probably peak of early release and liquidity stress, certainly perceived liquidity stress of industry funds that had unlisted assets. Are you able just to provide some reflections with that distance of time, the role unlisted assets played in terms of contributing to the performance of the fund? Did they fulfil the role that they're intended to do? And I guess I'll throw to you and see what your thoughts are on that.
Yeah, look, I think it was a very, very unique period. One of the things that I am quite pleased about is that we were able to basically balance a number of competing objectives. Firstly, we needed to make sure that the value of the assets in our portfolio reflected their true underlying worth. In other words, if I think about the unit price that we strike every day for advisors and members to transact at, we are duty bound to ensure that that unit price is as true a reflection of the underlying value of the assets as it can be. And so we moved very, very quickly during March last year to mark down the value of our unlisted assets to reflect what was inevitably going to be a very, very, very deep Australian and global recession. And we did that. That's certainly, and I think in the process, we also needed to ensure that we balanced that with members' demands for liquidity. So we needed to mark down the value of our unlisted assets. We needed to ensure that our members had the liquidity they needed, both those members that moved from balanced and growth options into cash, and then later those members that took advantage of the early release scheme. And we were able to do all of that while still actually taking advantage of the opportunities that financial crises throw up all the time. So we were able to take advantage of that crisis by buying some cheap assets during the depths of that market downturn. And the good news also is that I think that the superannuation industry as a whole, and Sunsuper in particular, has come through what was an incredible stress test of the system very, very strongly. So the demands for liquidity that we faced, for example, were well within the limits of what we previously stress tested for. And so consequently, we came through that crisis in a very strong financial position. So that was really, really pleasing. But certainly the concentration of the crisis in that 2 or 3 week period was truly, really, truly remarkable, actually.
And I think there's a few of us acquired some grey hair, well, many of us, and I'm sure you, as financial advisors as well, acquired a few grey hairs during that period. And again, recognition of the marvellous work you did, because with the benefit of hindsight, we saw those members that had a financial advisor were able to sort of hold the line. They didn't panic and move to cash. It was overwhelmingly people that didn't have a financial advisor that really did panic and sold out at the worst possible time and realised those losses.
Actually, and I might add to that, that's absolutely true. It was a real abject lesson in the value of financial advice, but it was also a lesson in just having a well-constructed default option for members. We also found that our members that were in the default, especially in that prime age group of between, say, 50 and 65, those members who were in the default were much less likely to make poor investment choices during the depths of the crisis. In other words, they were much less likely to move from higher risk investment options to cash or capital guaranteed. Whereas and that's a really important point, because superannuation default option, one of its missions, if you like, is to we don't want our relatively disengaged members becoming engaged with their super in a really negative way in the depths of a market downturn. And thankfully, the vast majority of those members didn't do that. So being in the default and getting advice were clear positives for the way you managed or the way you fared during the worst of the crisis.
Yeah, we saw many members logging into their app. There was one member that switched, they went in and out sort of 17 times in one day, logged in and out trying to, engagement is good with super, but there is a fine line. Now, Brian, I think, and Will, if I might, if we go to some Q&A, and I've got a couple of sort of Dorothy Dixes for you, Brian, 3 Dorothy Dixes around the merger with QSuper. And and the investments. And the first one is in relation to, and I would encourage our viewers again to sort of type your questions in as we get this going. But with the CIO and Deputy CIO being announced, is there going to be a change in the investment philosophy and strategy and the investment options?
In the short term, I think the answer to that is no. That's really, I think that the organisation is about to go through what I would call maybe a three-stage process. The first stage is really at the board level to come up with the overarching investment philosophy to guide the investment decisions of the merged entity, and that is very much a work in progress. The second step really is to then look at that overarching investment philosophy and to work out how to best apply that in terms of the range of investment options we will offer. What does our long run default option look like, and how do we make sure that we have the right options and strategies to meet the needs of a very wide range of members, and also different cohorts of members within the fund. That is going to take time. And the third stage really is to look at the two pools of assets and bring them together, but bring them together in a very, very careful, risk-controlled and cost-effective way. That is going to take time. And that's really something that you can't sort out in a matter of a few months. That could be a year, 2 years. It's more important, I think, to actually make sure we get that right rather than get that done fast. So that's the sort of next steps from here. In the meantime, if I think about the options that will be offered by the merged fund on day one, they're pretty much going to be the options that are currently offered by the two individual funds. So advisors and members really won't see any change to the investment offering in the short term because we've really got to make sure that we get this done properly, and that is going to take some time, and it's going to be done in a very careful and considered way.
So does that mean then, Brian, that we are going to retain the two very distinct investment strategies, just to, labour that point a tiny bit?
That's essentially yes. Yeah. So that in the short term, until you actually bring the pools together and until you actually do the work and identify what options you need to offer that are in the best interest of our members, you're going to be running two parallel investment offerings. And so again, you're not going to see changes to the investment offerings on day one of the merger. That is going to be something that will evolve over time. And most importantly, it's got to evolve based on this overriding investment philosophy that is currently sort of being formulated at board level. And realistically, as I said, it's going to take time, but that is Ian Patrick, that is his mission over the coming years, to bring teams together, to bring pools of assets together and do it in a way that suits the different member cohorts that we have and ultimately is in the best interest of all our members.
Okay, one last question for you around the merger in particular and investments, and then I might throw to you, Will, so putting you on notice. In relation to ESG, and obviously the interest in ESG just continues to escalate at a very rapid rate. And I guess, are there any insights you can share with our viewers around what the merged entities' approach will be in relation to ESG?
Yeah, well, the good news here is that there's quite a bit of commonality here. That both funds today have very, very strong and well-regarded capabilities in the ESG space, not just in terms of investment offerings, but in terms of the application of environmental, social and governance criteria to investment decision making. And so that's a very, very positive thing. Both ESG capabilities are well regarded in the external market. Both have very, very similar philosophies. The most obvious, I think, question to answer is, both teams are very, very focused on, protecting members' long-term financial interests from the effect of climate change. But certainly bringing that ESG capability and philosophy together is well and truly on Ian Patrick's to-do list when sorting out what the new fund actually looks like from an investment perspective.
All right, thank you, Brian. And it's great. We've got some questions coming through, so I've put on my glasses so I can read them. Age is a terrible thing. There we go. Will, this one is for you. Will we receive, and this is from Cynthia, will we receive a notification when the last payment has been made for advisor fees at the end of the fixed term agreement in order to continue with a new agreement?
Yes, absolutely. Cynthia, yes, thanks, Cynthia, for the question. Yes, absolutely. So we send an email notice to the advisor and to the member on the conclusion of the last fee payment. That's for both fixed term fees as well as the monthly ongoing fees. And look, contact your BDM. We do have an ability to pull a report as well of all your fees and how many instalments left of the fees. So put the BDM team on notice there. Please reach out to them and they can certainly help you out as well.
One more question to you, Will. Oh, actually, I might, Mara, thank you for your question. You've asked, if I have a fee form generated pre-1 July and not signed, can I get that signed and submit post-1 July?
Yes, thank you, Mara. So the form would need to be signed and dated before the 1st of July in order for us to accept that form.
I can't see who this one's from. If I have a fee form signed pre-1 July, what do I do?
Absolutely, if it's signed pre-1 July, as long as it's signed and dated before 1st of July and submitted to Sunsuper via Advisor Online within 90 days, we will accept that fee form.
Okay. In the spirit of diversity, Mr. Pucker, raised eyebrow. Okay, I'm going to throw it to you. And this is from Luke. Luke Hansen. What portion of the Sunsuper's diversified funds include index investments and what portion is actively managed?
Yeah, it's a good question. It's one we get a lot. I think, firstly, obviously, our unlisted assets and our alternative asset classes are all fully active. They're all actively managed, as is fixed income. So fixed income is also actively managed. Reason being, we just think that there's a range of structural reasons out there why a passive strategy doesn't make sense from a diversified fund perspective, but also given our scale, we can access active management of fixed income very, very cheaply. So if you were to go passive, you would expose members to quite long duration risk because a lot of the benchmark indices that you're replicating are yielding not very much and exposing members to a great deal of price risk. So we want that risk actively managed. But in equities, we have a balance of active and passive. So if I think about our Australian equity portfolio and our emerging markets equity portfolios, they're about 40% passively managed and 60% active. In developed markets, equities, it's about 50% passive, 50% active. What does that translate in terms of the diversified funds? So if I think about, say, the balanced option, about 23%, just over 23% of the balanced option, our flagship offering, where sort of 80% plus of members' money is located. About 23% is passive and the rest is actively managed. For the growth option, it'd be more like 28, 29% is passive. So that's kind of how it works out. Okay. And it's all very much based on value for money. We will use active managers where we believe they offer value for money, where we can be very convinced that they will add value that's a multiple of the fee we pay them over time. Not always, but over time. Where we can't be convinced of that, we will use a passive alternative.
Okay, so Brian, I'll throw one to you and then I'll jump back over to you. So Brian, this is a question from Richard. Has the fund considered any work in relation to the SIPA or retirement income framework moving forward? Any innovations taking place in regards to the product offering other than the income stream account?
I can't really answer that at this point. I mean, this is a work in progress over time, and it's also very much tied up with what sort of product suite does the merged entity want to offer. For example, QSuper have an offering that they've launched in the retirement space earlier this year, which has won some awards recently, which is great. But over time, what do we offer in that space? That is very much a work in progress. And so I can't really give a specific answer to that. I might actually defer to you on that.
Yeah, I think, yeah.
I'm just a humble economist. So.
No. And so, look, there have been there is, well, you're not a humble economist. You're a fabulous economist.
But still be humble.
Humble, yes, very modest. Look, we at Sunsuper, we've done a lot of thinking about this with an imminent retirement covenant. And the experience with our cohort of members is that the assumption that retirement adequacy has been solved, we don't believe is the correct assumption. Certainly with our membership, there's overwhelmingly a lot of people who are not retiring with enough money. And we think that ultimately to solve for that, there isn't a product that's a silver bullet to solve for that. We actually think financial advice is the closest to a silver bullet you can get in terms of retirement adequacy, because it requires people to react differently to how they feel about money, maybe spend less, budget better, make different decisions. All of this what advisors help people navigate through their working life and help them make the right choices. And obviously recognising too, people have other assets outside of superannuation that need to be taken into account when solving for retirement adequacy. But obviously, QSuper do have an award-winning product with their lifetime pension, and there is some keen interest for that, which is fantastic. So I might now throw to you, Will, and I think there is a question here, if I might, one moment, sorry, from, I can't see who it's from, but it's in relation to, is Sunsuper considering reviewing the fee caps and rules? Any comment there?
I guess the comment there, Anne, is that there's no changes today to any of our fee caps or governance. So we're not announcing any changes to there. But I guess we're always looking to improve the offering and take on feedback.
Yes, and look, I think too, obviously, once in this merger, the context of the merger, solving for advice fees is incredibly important. We have got some questions around what the new merged entity's approach to advice fees will be, which we will work through. Obviously, the new trustees of the merged entity have obligations that they need to adhere to relating to sole purpose test, relating to members' best interest. And so having a clear, consistent view on that we recognise is incredibly important for you, but also in the eyes of the regulator. And, obviously too, any clarity around sole purpose test, we're sort of keen to hear from the regulator any views they have around what sole purpose test means in the future, and so that we can comply with that. There's a question for me here from Kelly, which is in relation to a new company name for the merged entity, and there is going to be a new company name, but I can't tell you what it is. So it's in July next month. I think there's going to be a bit of a ta-da for that one. I hope that's correct, because I've now said it live on this webcast. But so there will be a whole host of things. So it is a bit of an end of an era for the Sunsuper brand. It's been an iconic. Certainly iconic Queensland brand, but this merged entity is going to be a big national fund. So I think we'll find that the new name of the merged entity will reflect Australia as opposed to sunny Queensland, which sits in the name of Sunsuper and obviously QSuper at the moment. Okay, more questions. I'm going to now Brian. Martin Letessier wants to know, it's an existential question almost, about when do you think the bull run will end and when do you think interest rates will start to rise?
Thanks, Martin. No pressure. I'll get a little hard.
This is recorded too, so we can play it back to you.
Look, it's a really good question, actually. It is the sort of $64 trillion question at this point. Firstly, if you think about how long bull markets last and who ends up killing off bull markets as a rule, it's generally the central bank. And one of the things, I suppose, one of the themes that has been operating in financial markets for some years now, and this was a theme pre-COVID, but it's certainly a theme that stays with us post-COVID, is that the world has been awash with liquidity. The world has been awash with money, with liquidity, looking for a home. And that's made it increasingly, it's made the market for assets increasingly competitive, and it's forced up the price of financial assets and real assets across the globe, and therefore forced down long-term future returns, almost really by definition. And until you see that liquidity start to dry up, it's very, very difficult to be too negative on equity markets. You may look at equity markets and say they've had a great run and on some measures they look expensive, and that may be true. But in an environment of very, very low interest rates, and in an environment of abundant liquidity, where there's so much money out there looking for a home, it's very difficult to be too negative. It's very difficult to say, right, let's ring the bell, markets are about to collapse. Economic expansions, bull markets don't die of old age, they get murdered by the central bank, is the old adage, which I've kind of adapted. And it's very difficult to see the world's major central banks turning that liquidity tap off and raising interest rates anytime soon. They've made it abundantly clear that they are very reluctant to do that until they see not just temporary surges in inflation, they need to see inflation sustained at a higher rate, but they also need to see unemployment rates across the world fall much lower. Now, on the timing of that, I'd note that even though the Australian economy has recovered a lot more strongly than pretty much anyone expected, and that's great, we still do have quite a good deal of spare capacity in our labour market. Even with closed international borders, there is still too many people either unemployed or underemployed. Until you see that, what I call labour force underutilisation, which is basically the sum of unemployment plus underemployment, that needs to fall by, I think, another 2 percentage points at least before you start to see a meaningful acceleration in wages. That's going to take some time, even with closed borders. So I know Governor Lowe is still thinking about 2024. Is there some prospect that the labour market tightens faster than that wages accelerate sooner than he's thinking? Yes, of course, that's a risk. And he may bring forward that timing. But I still don't think I see obviously no prospect of a rate increase this year. And I do think 2022 is looking relatively unlikely. I would have thought if it's going to be early, it's going to be 2023, not 2022.
Okay. Yeah.
And even then, and what it also means that for a lot of people actually allocating capital, with short-term interest rates anchored at these very, very low levels, there's a limit to how bad fixed income returns can get. How high can long-term interest rates go when the front end of the yield curve is anchored at very, very low rates? So for a lot of investors out there, equities and real assets are going to very much be maybe the only game in town for them. And they're still going to be looking for yield in those kind of markets.
Well, thank you for that very colourful explanation of a murder scene from the central bank. So I'll have that etched to my brain for him. And I should actually, to one slight correction, which was inevitable, I got overly excited about the brand release date. It's not July. Those of you know me know I am easily excitable. So it's not July, it's October. So I stand corrected. Thank you for pointing that out, marketing team. Now,
at least someone's paying attention.
I know, somebody's listening. Okay, so that I might throw to you now, Will, because Norm has a question about will Sunsuper accept an advisor's own fee consent renewal form?
Yes, thank you, Anne. I'm not sure I've ever been this popular, to be honest. So at this stage, Sunsuper will only accept our fee consent form, but we're looking at it. We're exploring the option of accepting an advisor's own or licensee's own fee consent renewal form. I should add as well that we have some time here because all ongoing fees at the moment are technically fixed term fees. And so the earliest that we could accept a renewal of an ongoing fee would be July 2022. So we're looking at it. We would like to be able to release that capability. We just have to do our work on it to make sure it meets our...
Yeah, and to be honest, it's not easy. Again, in the spirit of honesty now, lots of themes, resilience, honesty, communication. This one is challenging because obviously the T's and C's on the Sunsuper form are very much in relation to our trustees and their obligations to members associated with advice fees, where an advisor has a different set of obligations, legal obligations that they need to adhere to. And so that's, I guess that's the challenging bit we would have to work through. But we certainly want to do everything we can to create simplicity and make it easier for more members to get great, affordable, accessible financial advice from wonderful people like you.
Should add as well, and we actually haven't seen one yet as well.
Well, true.
We need to get a few examples through of what's included to make sure we can do it.
Yes. Okay, Brian, I have a question from Sean for you that I will read out. Could you provide some guidance on whether there will be changes to investment options during the merger? Obviously, diversified options would merge. The question is more directed to single asset funds like index Australian shares, property, etc., which are Sunsuper offerings but not QSuper offerings.
Thanks. That's a good question. And again, in the short term, there is no change. As I said, I think in the answer to an earlier question, it is going to take time to work out, what suite of investment options do we want to offer the different member cohorts, different segments of the market that the merged fund will service. Obviously, we have a substantial book of business through financial advisors now. And full credit to my two presenting colleagues here and the rest of their team, that the amount of business from financial advisors is now a meaningful chunk of Sunsuper's assets under management and membership. And we're acutely aware that having single sector, particularly passive single sector options, is an important part of our offering to financial advisors. And so at least in the short term, and I strongly suspect in the long term, we will continue to do that. In the shorter term, though, there is going to be one obvious change. As many of you will be aware, our friends at Vanguard have decided to no longer service the institutional market here in Australia. And so consequently, we will be changing passive manager over the coming weeks to months. And we're very, very close to an announcement on that. And that's a fairly seamless exercise. It's a matter of literally unplugging one manager from a pool of assets, plugging in a new one, and probably lowering the fee, to be frank. So that's really the only obvious change in the short term, a change of manager and potentially a lower fee for our passive options. So watch this space on that.
And I think that's what's really exciting about that is with the merger, the benefits of scale. Everyone knows that it's a thing. It's important. The regulator views it very important. But I guess seeing it when we announce that merger, that's when we have the opportunity to really test the benefits of scale when you're negotiating on fees with managers and the like that ultimately members are the beneficiary of. And again, lower fees makes advice more affordable too, which we think is a really, really good thing. A question for me from Carissa, and it looks like the last question here. So any final questions, send them through. But at this stage, this is the last one about, is there going to be a new website for the merged entity? And you bet your bottom dollar there will be a brand new website for the merged entity at the end of the year. So at this stage, we're looking towards mid-November for the wedding, as I'm calling it, the wedding of the year, but between QSuper and Sunsuper. So look, on that note, I think, are there any final remarks from you, Brian, to our advisor viewers before they get ready to close out the end of financial year with their clients?
Nothing in particular, but I suppose one thing I do is, again, just reiterate a comment you made before. We just really want to thank financial advisors out there for the work that they do for their clients and often our members, and just reiterate that, Sunsuper recognises the value of financial advice. And I think if I can think about it from an investment perspective, one of the challenges that we face, especially after such a strong recovery in investment returns, if we were on this call a year ago, and if I'd have said to this audience, you know what, for the year to June next year, we're going to have double-digit returns, it's going to be brilliant, I would not have been invited back. But that is the year we've had. And I think when you go through a period of very, very strong returns, I think it's really, really important to manage expectations and to ensure that our members have a realistic and sensible expectation about what sort of investment returns are achievable and sustainable over time, especially in an environment where interest rates and bond rates around the world and here in Australia remain very, very low. For our balanced option, for example, we still believe that net of fees and taxes, a good diversified investment option gives you 3.5% above inflation over the coming decade. And it's our job as an investment team to hit that target and to do everything we can to increase our chances of hitting that target over time. But being realistic about what's achievable, especially after such a very, very strong period of performance, I think it's an important message to communicate to members.
Well, Will?
Sorry,
Yeah.
interrupting.
No,
I just
not
have
at all.
one more question coming through, if,
okay.
If that's okay. It's
Yeah,
just been
sure.
messaged through to me. It's just a quick question from John. The question is, will ongoing advice fees automatically switch off after 12 months, or is there a grace period available? So for our ongoing fee, just to clarify that, it will cease at that 12-month period. However, we will allow the 120 days, off the top of my head, 120
Yes.
days for us to accept the fee renewal form, and we will then back pay for any periods of time. So the fee will cease at that 12 months, but once we receive that renewal form, we will make up those missing months. Just want to clarify that one.
A good one. So to close out, I think what is the future like? And I'm going to elevate it up a bit. That Australia is getting older, and more Australians are actually interested in superannuation in their retirement. I think the Royal Commission the Royal Commission was a tough time, but it did many good things too. And one of the good things it did was the everyday Australian paying attention to their superannuation, which is the biggest or second biggest asset they'll ever own. And I think what's wonderful about that is that we're seeing our members continue to engage, use tools, and slowly start educating themselves. And you all know that once you develop some curiosity around superannuation and investments, the more you learn, the more you realise you don't know, the more you understand the complexity associated with it and the importance of making the right decision. So we think there's enormous opportunity for financial advice. We know from over decades of experience, when people hit the end of their working life, they've got some big important decisions to make, and that a lot of those decisions have complexity, emotional and financial, and that they need a trusted advisor to help them guide their way through it. And so we see with all of those dynamics at play a huge opportunity for the role that you play in our members' lives to help them secure the financial security they deserve at the end of their working life. And there is much more work to do. There are still many women predominantly retiring in poverty or, in a very financially vulnerable situation, and recognising that problem is bigger than all of us to solve and requires policymakers in the future to solve for that. But what you do right here, right now, really does matter. We thank you very much, and we look forward to continuing to work with you and celebrating when Xplan data feeds go live at the start of next financial year. Hip hip hooray! All right, thanks everyone for coming along and viewing today's episode. We'll see you next time. Thanks, Will. Thanks, Brian.
Thanks, Anne.
Thanks, Anne. Thanks, Will.